I've enjoyed listening to all these different ideas about the GSEs and what to do about them. A lot of my comments are based on what I heard this morning. And what I heard this morning was largely a consensus. So what I'm going to do while I'm waiting for my slides to show up is just start talking about my take on the GSEs and try to integrate it with what I learned from everybody else. So the first big question is, why did the financial crisis occur in the first place? And I think there are two answers to this question that are hard to distinguish. One answer is that people just thought housing prices couldn't fall. They were irrationally exuberant about housing prices. The second theory is that there was some kind of risk shifting going on, a version of moral hazard. And the risk shifting that was going on was encouraged by the fact that banks had capital requirements that were too low, that encouraged them to use debt financing to kind of increase the value of a kind of put option that would come into play if the banks failed. So that is, in my opinion, those are the two reasons that we can think of that are the main reasons why the financial crisis occurred in the first place. So the question is, what is the role of the GSEs in this? And I think that the GSEs' role in this was kind of doubly bad in that they seemed to practice irrational exuberance up to a point. If you look at the statistics like we looked at this morning, you actually see that the GSE share of mortgages was falling during the worst part of the bubble. That kind of makes them sound innocent. But on the other hand, they were actually ramping up risk-taking quite dramatically by engaging in riskier activities as they participated in the boom. So I think that the result of this was that the rush to lend money to people to buy homes pushed up home values much faster than they would have gone up otherwise, and actually made housing prices much less affordable during the bubble than it was before. And if housing affordability, as opposed to just liquidity in the mortgage market, is something that we think of as a worthwhile objective for GSEs, that was certainly not something they were helping during the bubble. On risk shifting, the GSEs were even more levered than the banks. Many of the speakers have made the point that the banks nominally should have faced about a 4% capital requirement for investing in relatively safe mortgages, but by running the mortgage-backed securities through the GSEs and buying them back again, the capital requirement is effectively reduced to about 2%. The GSEs maybe 0.5%, and the banks maybe 1.5%. And certainly, if you look at the cost to the taxpayers of the GSEs compared with everything else, the GSEs are going to be far more costly to the taxpayers than everything else put together. I'm guessing the second most expensive thing would be the automobile bailout, which was, I think, partly more a bailout of the PBGC than the credit markets or financial system. But even taking that into account, the bailout of the GSEs is going to be far more expensive than AIG and all the banks put together, even if you do the cost-benefit analysis correctly, which I think the Treasury doesn't do. They like to use the out-of-pocket cost, which is, we bought Citigroup at $3 a share and sold it at $3.50, therefore we made a profit of 50 cents a share. When the proper way to do the cost-benefit analysis is we bought it at $3 a share when it was trading at $1 a share, overpaying by a factor of 3, and we got a return of 20% or something when a market index of similar securities would have gotten a return of 300 or 400%. Even taking that into account, I think the GSEs are going to be more costly than everything else put together. The financial crisis was not caused by a bunch of other things that people have attributed to causing it, and I think the speakers today are broadly consistent with the points I've got here. It wasn't really caused by securitization. Securitization allows slicing and dicing of risks in a manner that I'll talk about later, does not rely on leverage as much as other possibilities. Wasn't caused by the originate to distribute model because the originators actually got stuck with their own cooking. They died from the food that they had cooked in their own ovens. And I've listed Countrywide, WaMu, Bank of America, Merrill Lynch, Lehman, Bear Stearns, and Citigroup. They didn't all actually die. Some of them were miraculously resurrected by government bailouts. It wasn't caused by derivatives and short selling. And indeed, I think derivatives and short selling performed a valuable service of helping end the crisis earlier rather than later, and I think this is consistent with Susan Wachter's comments earlier. We didn't hear much about rating agencies today, but I think the rating agencies were just a chorus cheering along what was going on, not a prime cause moving things. Well, there's a lot of discussion about what can the government do well and what does the government intrinsically do poorly. There's one thing that the government, I think, intrinsically does poorly, and I think many of the speakers today said this one way or another, and what the government does poorly is price credit risk, except for Debbie Lucas, who is working for the government and trying to price it well. But when governments try to price credit risk, it's very difficult for them to do it. And one of the reasons because they're doing it in a political environment. Actuarially fair prices or market prices for credit risk are likely to fluctuate greatly. It fluctuates with market conditions, it fluctuates geographically, it fluctuates with different types of borrowers. Whenever the government gets into pricing credit, the government is going to be under political pressure to kind of treat everybody equally. Stable prices for credit over time, stable prices across different kinds of borrowers, and stable prices across different geographies. Well, one of the problems with this is that the credit risk also tends to be underpriced. But in addition to the problem of underpricing the credit risk, the stable price of credit risk, when it should be fluctuating, actually is going to destabilize the housing market, because you'll find that at times when the housing market is peaking out and prices should be collapsing, the government should be charging enormously high prices for credit risk. That's actually when the private market forces are withdrawing from the market. But what the government subsidized credit does is it tends to make the boom go on longer than it would otherwise. That results, of course, in an overhang in supply of properties, because it encourages more construction and makes the crash on the opposite side greater than it would otherwise be. So the general point is that if you stabilize quantities, you tend to destabilize prices when the forces of supply and demand are still trying to operate. We heard a lot about risk premiums. I'm going to make a few economist points as we go along here about terminology. But to me, the word risk premium has three different meanings. It means what I call a default premium. That's a credit risk premium, or the price of credit insurance. That's typically the way that you heard it used today. But it also can mean the expected return that you need over and above the risk-free rate to reward you for the risk-taking that you are engaging in. And it also can easily be confused with something we would call a liquidity premium. And that liquidity premium I think of as the idea that Treasury securities have a much lower yield than other types of securities, and we're inclined to attribute that low yield to the fact that the Treasury securities are unlikely to default. But the fact of the matter may be that the low yield is due to the fact that the Treasury securities are very easy to trade, and therefore and have great liquidity in the sense that bid-ask spreads are small and large quantities can be dumped into the market without having a large effect on prices. And indeed, one of the things we saw during the financial crisis was that the U.S. dollar denominated Treasury securities actually rose dramatically in value, and the price of everything else was declining, precisely, I think, for the reasons of a liquidity premium. Now, the problem with these three different types of risk premiums, the three different ways in which the word gets used, that it's very difficult in looking at market prices to figure out what's what. It's hard to separate a liquidity premium from a risk premium from a default premium, and so that's going to create problems for us. Well, one way to sort of frame the discussion that was alluded to by many of the speakers, especially this morning, was try to explain, how much of an effect do Fannie Mae and Freddie Mac have on mortgage rates. And if you looked at the spreads between the jumbo market, which they presumably weren't affecting that much, and the conforming market, which they presumably were affecting, you saw that before the financial crisis, there was a spread of about 25 basis points. So there's a question, how much of this is a default premium, meaning that Fannie and Freddie have allowed the conforming mortgages to be insured for credit risk at a price that's sort of too low? How much of it is a liquidity premium, meaning that Fannie and Freddie have actually achieved their objective of making mortgage-backed securities more tradable in the market? And how much of it is merely a risk premium, maybe because people think that the risks on the assets are different, which I think is doubtful, but the other two it's very difficult to distinguish. Then after the financial crisis erupted, we saw these credit spreads widen to well over 100 basis points, and it persisted at very wide levels for a long time. So how much of this is a default premium? That is that the GSEs are underpricing the insurance value even more. and how much of it is a liquidity premium. Maybe the Fed is buying in its quantitative easing, effectively propping up the price of conforming mortgages, but not propping up the jumbos as much. And so maybe it's the Fed essentially creating a liquidity premium for the conforming mortgages, but not the jumbos that's making the spread so wide. So it's very difficult to answer these questions, but the answer is kind of important because on the one hand, one answer might suggest that the Fed is the entity that we should rely on to deal with the issues that arise in the housing market, and the other would suggest that we need something, maybe something like a GSE is interfering with the housing market either for better or for worse. I think I said this earlier, some of my slides I was typing in real time are a little jumbled together, but let's look at these pressures that the government operates under when it tries to price insurance. It operates under these pressures for all kinds of insurance. If you look at the last bullet point first, the floods in Florida are one example of this. But how do you politically explain to somebody in Miami that they should pay maybe 200 basis points a year for credit insurance on their condo while somebody in Lubbock, Texas pays only 10 basis points? I think it's politically impossible to do that, but yet I think the prices of credit insurance might have varied by these types of magnitudes leading up to the financial crisis, and that this makes it really politically impossible for Fannie Mae and Freddie Mac to charge realistic credit insurance premiums. But if you left it to private market forces, there's probably some savings and loan association in Lubbock that would charge the 10 basis point premium, and maybe the ones in Miami would know to charge the 200 basis point premium if they had the proper incentives to do so. There was a lot of talk today about market failures and whether government could fix them, and I think I disagree. Although I've agreed with a lot of what people have said, I think I disagreed with pretty much all of the stuff about market failures. Is systemic risk a market failure? I don't think so. It's something I call a pecuniary externality. You know, there are a lot of young people that have moved to DC and they've made the rental market here really expensive, and I'm a renter, and you know I can blame it on them, but it's not an externality. It's just my bad luck that I live in a popular city. And similarly, it may be the case that highly levered investors who've chosen to be highly levered vary their consumption a lot with their housing prices going up and down, and that makes the economy more unstable, and that creates more systemic risk. But it's not an externality. It's just too bad for me that they have chosen to behave that way. What about moral hazard? Is that a market failure? Well, the way I look at moral hazard is not a market failure. Moral hazard is kind of part of the technology of being able to observe things, but not a market failure, so the government's not going to fix it. What about neighborhood effects? Yes, those involve externalities, and so they can be market failures. Similarly, network externalities are an important part of the mortgage markets. So those are things the government could potentially fix. What about adverse selection? I personally don't think of adverse selection as a market failure. I think of adverse selection as raising issues of redistribution, that basically if I don't offer a mortgage to a good person because I can't distinguish that person from a bad person, it's kind of too bad for the good person. And if I choose to maybe lose money by offering mortgages to both, where I'm making a little profit off of the good person but losing a whole lot of money with the bad person in the pool, I'm redistributing some of society's wealth towards that bad person. We often, people think that there's some positive externality associated with homeownership, and therefore making mortgages to these good people who would like to be homeowners but would otherwise be shut out of the market is a good idea. But I must tell you, I think there are big negative externalities associated with making mortgages to the bad risks in the pool who get pooled together when you try to mitigate adverse selection. These would be the people that are trying to flip houses with liar loans, and then as soon as something bad happens, you have a house falling into disrepair in the neighborhood, and it's having it is having an effect on the rest of the neighborhood through what I'm calling a neighborhood effect. So a lot of what I heard were market failures today I think are not market failures. And indeed, I'm going to say in a minute, I think that they were not market failures to begin with, but they became market failures in the sense that the government in some sense manufactured a problem where one didn't exist. And a good example of that is the systemic risk that the government has manufactured by keeping capital requirements too low leading into the financial crisis. So if we're going to fix the housing finance system, my opinion is that we should fix the banking system first. I didn't hear a whole lot about that today, but I think maybe a little bit about it. The government does not price risks very well, and it is credit risks very well, and capital requirements for banks are supposed to be so large that banks just aren't going to fail. The fact of the matter is the capital requirements are not large enough, and banks do fail. That put option, which is the ability of someone who's a stakeholder in the bank to get bailed out when the bank fails, can be valuable, and it fluctuates in value over time. So the capital requirements were too low leading into the financial crisis, making that put option valuable. And the risk-based capital requirements that were being introduced under Basel II didn't really have enough flexibility in them to counter that. If anything, they appear in retrospect to have made it worse. So what happens is that the low capital requirements create a higher probability that the bank itself is going to default. That means that as you reach a point kind of at the peak of the business cycle where everyone looks around and sees, oh, it's really much more dangerous now than I thought, the value of that put option has enormously magnified, meaning that the government is enormously subsidizing risk-taking at exactly the wrong time. And that has created a lot of what we think of as systemic risk as a result of bad capital requirements. So we like to call that moral hazard. I'll talk about more about what else we call moral hazard in just a second, namely right now. So the word moral hazard gets tossed around a lot, and I've tossed it around so far quite a bit. But to me, it means three different things in the context of the housing market. First of all, there's this idea that a renter or an underwater homeowner maybe doesn't want to invest in his home or doesn't want to invest in the neighborhood, and that creates a problem if there's a foreclosure. That's a legitimate use of the term. It's also used in the context of what I would call kind of a pump and dump moral hazard in the context of criticizing the originate to distribute model, the idea being that the originator of mortgage-backed securities might engage in very shoddy underwriting, but he doesn't care because he's going to sell the securities to somebody else. That argument, I think, is actually theoretically an interesting argument. I'm going to show you a slide in a minute that says it doesn't apply to the housing crisis. And then finally, moral hazard applies to the idea of risk shifting, that the bankers that know that their capital requirements will too low will ramp up risk taking because they realize that they're going to be subsidized either directly or indirectly by taxpayers. And it's kind of indirect because the bankers probably know it's their creditors who are subsidized, the depositors or the bondholders, and not the equity holders. And that was pretty much borne out in the financial crisis. There are also different levels of leverage that are made possible by the way the housing market works and different ways of thinking about leverage. Leverage is a big amplifier of systemic risk, because we know that when you're highly levered and you lose money, you're short on capital, so you tend to dump securities in the market to delever, and that tends to amplify what's going on. But leverage arises at different levels. There's what I call implicit leverage that's in the risky tranches of securitizations, and that implicit leverage is actually kind of beneficial because the risky tranches of securitizations kind of delever themselves as they collapse in value towards zero. They don't require that the owner go out and sell something to get back to equilibrium. So they're kind of dynamically stable in that sense. So that's a good thing about securitization. But banks have incentives to over-leverage when being more levered, increase the value of bailouts to their creditors. So if it's the bondholders of banks that are going to be bailed out, not the equity holders, banks will have an incentive, of course, to have more bondholders than they would otherwise need. And indeed, Bear Stearns and Lehman Brothers and some of the other banks had, in my opinion, far too much leverage. But also household leverage affects the sensitivity of overall consumption to aggregate shocks. So the macroeconomy becomes sensitive to how levered households are. And Atif showed you some slides just a few minutes ago making that point. So both bank leverage and household leverage, but not the kind of implicit leverage that shows up in securitizations, can lead to macro instability or systemic risk or whatever you want to call it. So let's talk a little bit about the, the dynamics of the pricing of risks. the market appeared to underprice risk at some times during 2006 and then overprice risk in 2009. But this cycle of underpricing and overpricing does seem to have been affected by government policies. And I think the idea that these insurance fees that Fannie Mae and Freddie Mac were charging were too stable, or that the bank regulation was not clamping down on capital requirements soon enough, tended to amplify this dynamic and has made the business cycle worse than it would otherwise have been. Okay, so I've talked about some things that the government does poorly, or one thing that it does poorly, which is price credit risk. The government can do some things well. The thing that it can really do well and has a huge comparative advantage over the private sector and is creating liquidity. So when at least this is the United States government and the British government, but not the governments of the countries in Europe. So I think that the Treasury, if necessary, can just print money, and when the Treasury prints money, it adds liquidity to the system. But private market forces can't really print money like the Treasury can. So the Treasury, in this sense, can do something that private markets can't do, and that makes the government essentially the lender of last resort. It justifies the quantitative easing policies that the Fed is following now. The government can also do some other things, and Susan Wachter talked about some of these. Define standards for non-predatory mortgage contracts, define property rights, and mandate centralized clearing and trading of mortgage assets. All these things are very valuable, and it's also hard to imagine private sector doing these kind of things as well as the government can. So let me, in the interest of time, skip through these. I've got 4 slides here on the 4 points I just made. But I want to talk about, skip ahead and talk about securitization. So securitization is actually good. I said it wasn't a problem for the financial crisis, but it's in some sense part of the solution. It allows risks to be sliced and diced so that large risks can be concentrated in maybe a small sliver of the securitization. And that would allow maybe someone who owns 4% of the value of all the assets to be bearing 80% of the risks. So that's a good thing in that it's for 2 reasons. Number one, it's kind of an alternative to leverage, which could be destabilizing. What will happen to the equity tranche or the risky tranche of a securitization is its value will just kind of fall to 0 very quickly if there are a lot of defaults. The second thing that's good about it is that if you have originators of mortgages who are somewhat thinly capitalized, I mean, they need to have some capital, they can, by owning their own first loss tranches, have a whole lot of skin in the game without having a whole lot of capital on the table. The alternative would be for them to borrow a lot of money, and I think that would be much more destabilizing. So the securitization, I think, is part of the solution to problems and not part of the causes of the problems. Similarly, derivatives and short selling, the creation of the synthetic securities did allow short selling. Short selling, I think, brought the bubble to an end sooner rather than later. We should thank John Paulson for having brought it to an end sooner rather than later. I think Susan Wachter said something that was consistent with Goldman Sachs doing God's work with the Abacus synthetic CDO squares, although I don't know if that's what she meant to say. And we could imagine even people shorting the Case-Shiller index, but my understanding is there's not a lot of trading volume there, so there is an interesting question as to why there's not that much interest actually in short selling these instruments except at particular times. All right, I said earlier I'd come back to the originate to distribute model. The theory of the originate to distribute model, that's the good theory, is that originators are going to season the assets before they sell them. And because if assets are going to go bad, they're probably going to go bad while they're seasoned. It's the originator that's going to get stuck bearing the loss. The counter theory, which is that originate to distribute model is bad, is the idea that the originator just dumps the assets onto innocent investors who don't understand how bad these assets really are. Well, the counter theory, I think, applied very well to the dot-com bubble. Dot-com bubble collapsed, and the investment banks didn't seem to lose all that much money from its collapse, even though ordinary investors lost trillions of dollars. But it doesn't apply to the housing bubble because the big originators of these mortgages actually got stuck with the mortgages themselves. I'm going to skip this thing on rating agencies. So what's a path to fix the housing finance system? I think the first problem is that capital requirements are too low in the banking system generally. We need a much better capitalized banking system. They were too low to begin with, and then the banks got hit very hard with credit losses and lots of things, not just housing. So we need higher capital requirements, and we need to get the banks to recapitalize before we can fix the financial system. As it is right now, we've got the GSEs who are bearing a huge amount of credit risk, but also sitting on what I understand to be an infinite amount of capital supplied by Congress, so that without, if you just took them out of the market, you would be essentially taking away a lot of the capital, effectively, a lot of the effective capital in the financial system. So let's see. So if you want to, having fixed the financial system by recapitalizing the banks, what are the ways to actually subsidize housing? There's the world is, in other words, the GSE is a good way to do it. There's a worldwide savings glut, which kind of subsidizes housing in a way, although I wouldn't call it, a subsidy in the sense of a market failure. There are also subsidies that operate through the tax system that encourage homeowners to buy houses that are kind of inefficiently big. And then there's finally subsidies through GSE intermediation in markets that also not only subsidize housing in general, but also tend to redistribute wealth towards younger, perhaps poorer, but maybe I shouldn't say that poor, younger middle class, more highly levered borrowers, or maybe younger, wealthier, more levered borrowers, especially on the coasts. So what you could do, there are a lot of proposals put forward today of just kind of phasing out the GSEs by lowering the conforming loan limit, limiting the size of their loans, disallowing portfolio investments, making them raise the fees they charge to ensure credit risk, and do this in a gradual way that would phase them out. And I would warn that you want to do this in a manner that respects the capitalization of the banking system. If you did have a well-capitalized banking system, would it have the ability to absorb the housing credit risk that it would be asked to bear? And I actually think that the risks in normal times, I think Dwight Jaffe's consistent with this, that you would get from high quality, conforming mortgages would be quite small relative to the other credit risks that you see out there. The junk bond market is huge, and there are a lot of risks in the junk bond market. Commercial real estate has a lot of leverage too, and it's got a lot of risks. So if you look at all the risks that the bond market is bearing and the appetite for the risks, including the sovereign risks that markets have historically gone after and are going after today, I think that it would be easy for the markets to absorb the credit risk that you would get from high quality mortgages in good times. So what would happen if you sort of took the GSEs out and had a healthy system? What would it probably look like? Well, I think a lot of speakers said, and I agree with them, that it might look something like what I'm about to say, that the banks would originate and securitize mortgages into large pools of prime mortgages. It would probably be a good idea if they retained an equity stake in their own portfolios, say owning, I'm just making up numbers here, but owning the bottom 4%, the riskiest 4% of a securitization, so kind of they lose the first 4% that is going to be lost on those securities. That would be financed, in my way of thinking, with a 100% equity. That is 1,250% risk-weighted assets type of capital requirement for the banks. The safest pieces, the top 80% of these securitizations would probably be effectively AAA, and there would be an ideal security for the Fed to intervene in the markets for, just as they're intervening now. And so it leads the tricky part, and the tricky part is what about the risks that are between the 4th percent, and I'm making up a number, but the 20th percent of losses. The risks there would need to be picked up by bond funds, hedge funds, banks themselves, or any other investors that would probably be the same types of investors that would look at the junk bond market and decide, do they want to go at the low end of investment grade, or at the high end of junk grade, or even deep down into junk. And so the question is, would we need to keep kind of a mothballed GSE on hand to step into this part of the market if it were needed? My own preference is to let the Fed do that, but it could be that there would be some kind of standby government agency that would step in, but only in a market crisis, to intervene in that part of the market to prop things up. So I think I'm going to stop here. I had a few more slides of summarizing things, but I'm going to stop here and say that I think there was a lot of consensus among all the speakers at the conference that the GSEs have kind of lost their rationale for doing business as usual, and perhaps need to be replaced by a different model that has a lot more kind of market forces in it, and a lot less, let's say, government attempt to price credit risk, which it does not do very well in general, in most circumstances. So thank you.
Thank you.